Hello, everyone, and welcome to a market update for the first of this year. It is the 13th of January. Welcome back, everyone, and Happy New Year. And I hope you had a good break. I certainly did. It was nice to recharge the batteries and have some time off and let the mind wander and read a lot of books and do a lot of little projects around the house. I hope you all had a similar experience with friends and family and having time off. Hopefully, you're still actually having time off. I came back to work this week um, just to kick off the year and get things underway. Luckily, it's been fairly quiet and not too strenuous for the first week back, so that's been good. Top three things. We got a lot going on this year, and I'm so excited about what this year has in store for us. Truly, there is going to be some, I think, big changes. I'm going to talk about those as we go along. But top three things today are, first of all, CPI, so Consumer Price Index. Going to talk about that. That's the measure of inflation. Number two is interest rates, and number three is earnings slowing. So let's talk about CPI. We have Australia has reported CPI numbers this week, and this is a chart of that on your screen here. The CPI went up, shockingly. I think many people thought the CPI was going to go down, but there was a bit of a surprise up move in the CPI, which is like, that's not good for anyone who thought that Australia was going to start cutting interest rates, or the RBA rather was going to start cutting interest rates. You can forget that based on this CPI report. CPI popped from, I think, 6.9 in the October reporting period to 7.3% in the September reporting period. So this is not good. In the November reporting period, 7.3% in the November reporting period. That's not good, and that means that Australian interest rates are not going down anytime soon. So I'm going to say a few things about that for any of you, and I know a couple of you have reached out to me asking about buying an investment property, this sort of thing, and I'm going to make a plea here to talk you out of any such ideas at this stage, at least. And there's some reasons for that, and I'll go into those in a second. But this is bad news for Australia at this stage because inflation is not under control here yet. In the U.S., we also had the CPI print last night, and it came in as expected, 6.5%. It has come down slightly over previous prints, which was projected in the last macro themes deck. I may have shown you guys this slide, but this is the U.S. headline CPI numbers coming down, over the course of the end of 2022 and then into 23. And we'll see if this, plays out this way. But definitely in the U.S., we are seeing inflation beginning to subside a little bit, but still at elevated levels. Like the reality here is that CPI of 7% or 7.3% is horrendous. That is a terrible number. CPI, if you just look at this chart real quick, back in, going back to November of 2018, when this particular chart starts, we were sitting at, 2 to 3% in that range, which is what the RBA sort of had targeted. Inflation fell off a cliff because of COVID. And of course, the response from central banks around the world, and particularly in Australia, was to print a lot of money and put all this liquidity into the system. So it's really no surprise then that the prices of stuff have gone up because if you recall, and I've said this before, but it's been a while since I've said it, the result of printing money, which is the expansion of the money supply, that's really inflation. That's what inflation is. It is the expansion of the money supply. That eventually causes prices to rise, and that's the result that we see is a higher consumer price index. So that is bad, and it's bad for a number of reasons, and I'll continue to articulate those as we go along. But let's talk about interest rates. What does it mean for interest rates? Well, they're not going down. The RBA, the U.S. Fed, have signaled that they want to get inflation under control, and this print has just given the RBA absolute cover to put rates up again at their next meeting, which I think is early February. So the size of the rate increase is anyone's guess. I reckon it'll be 25 to 50. I'd be pretty surprised if they went any harder than 50 basis points. And I suspect they'll do 25. But then again, with an increase like this in the CPI, where expectations were probably for it to drop a bit, might be problematic. And just as an aside, the biggest contributor to the increase was that dwelling prices went up a massive, almost 18%. And so that's labor and material costs contributed to that increase, and that's in the annual rise in dwelling prices. So they're probably looking at the housing market going, well, we really need to get that, get the speculation in that, get that under control. Anyway, we'll see what the RBA does. I'm not making predictions as to what the size of the rate rise will be, but there will be a rate rise. You can almost bank on that. The U.S. Fed has continued to also signal that they are going to continue raising rates. The last couple of weeks in the mainstream media, the story that's being told by Wall Street and the mainstream media is they're trying to talk the Fed into a pivot, whatever that means. And they're saying, the Fed's going to pivot. They're going to start cutting rates, blah, blah, blah. Well, no, they're not. The Fed, Chairman Powell actually came out this week. I think it was in Switzerland, giving a speech to a bank there, and he basically said, we're not cutting rates in 2023. We're going to continue increasing interest rates. Our mission is to get prices under control and get inflation under control. He's basically told the market exactly what he's going to do. But I don't know why, but the market doesn't seem to want to believe him. So when the Fed meets in early February, we're going to see them increase rates as well. And that rate rise, again, I don't know what it'll be. Could be 50 bips, could be 25, but they're going to put rates up. And that's not a pivot. So a rate increase is absolutely not a pivot. It's a rate increase. Putting rates on hold is not a pivot. That's just leaving them as they are. And until they signal and actually do cut interest rates, we have no pivot. So I talked about this, I think, late last year and in my last market update, but we're not going to see a Fed pivot, and I don't think we're going to see an RBA pivot until late this year. And it's going to revolve around these numbers, these CPI numbers, until they come back down and get back down, at least in Australia, back in this 2 to 3% range, and possibly even lower for a bit longer. We're not going to see any pivots. So what does that mean for interest rates and the CPI? What does that mean specifically for the housing market and borrowing? I think I mentioned this in my last market update, where I said that I think we are undergoing a global regime change in the cost of capital. What does that mean? Well, the cost of capital is how much it costs you and I to borrow money, to buy houses or cars or what have you. And the cost of capital has been too low for too long, exceptionally low, dangerously low. And when I say dangerously low, what I mean is that it's been too easy in some respects to borrow money, and money has been too cheap. And this is the after effect of that. And now the danger on the flip side of this movie, or the second half of this movie, is that people that ran out and borrowed to the hilt and might have been real close to the edge in terms of how much they could borrow, say 2 years ago to buy a house, are all of a sudden going to have their mortgage interest rates resetting and rising. You may recall that I mentioned around June of this year, there's going to be a massive reset of interest rates. I think this is going to cause a serious problem in Australia for the marginal borrower who just got into the house, hasn't had a pay rise or a very nominal pay rise, has watched the cost of living go up substantially, and now their mortgage payment is going to just go up by 30 or 40%, and they're going to go, oh my God, how am I going to survive this? So I think there's a little bit of a ticking time bomb in the market, at least in Australia, in the housing market going on there. We'll see. Time will tell. I'm not going to sit here and make a prediction. I'm going to suggest to you these are the things that we have to pay attention to. But I'm also going to suggest to you that as a prudent investor, now is not the time. And please, if you're thinking about buying an investment property or going and borrowing money to do anything, there's one exception that I'll explain in a second. But to speculate in anything, I would please be very careful about doing anything like that. Because there's a good chance that if you go out and buy an asset like a home or an apartment or something like that as an investment, that it will A, be declining in value, and B, the cost of holding it is going to go up for you. So I don't think now's the time to buy any of that. The only exception that I would say I will make to that is if you're going to buy a principal place of residence. And the reason for that is because we know that, first of all, Australians and Americans, but homeowners, once they get into that home, they will move heaven and earth and do everything they can to not lose that house. That's number one. But your time frame for holding it is much longer. So typically a home owner will, they'll own their homes for 10 years plus, barring any other, circumstances that might arise, like if someone dies or if they have to, they choose to move cities or something. Generally speaking, people stay in their homes quite a while. So that's fine. If that is your game plan, then I don't ever really think there's a bad time to buy a home. But what I will say is if you are thinking about buying a house to live in, just wait about another 3 to 6 months, and I think we're going to continue to see Australian property prices drop, particularly in the capital cities. We saw a 12% decline in Sydney and an 8% decline in Melbourne over the course of the last year. Those are CoreLogic data points. And I think a 1% decline in Brisbane. Other capital cities actually went up. I believe Hobart, Adelaide, and there was one other, it might be Perth, actually went up over that period of time. So we'll see if that continues, but with these interest rate rises that I think are coming. But nevertheless, the capital cities, Sydney and Melbourne being the biggies, got pounded, and I think we're going to continue to see that happening. So that's a little bit of a rant on interest rates and the cost of capital. So really, if you're having conversations with your family, your loved one about investing and borrowing money, please have that discussion about the cost of capital. And if interest rates went up to 7%, what would that do to your free cash flow? And that's ultimately what this is all about, is figuring out a way to generate free cash flow. And I've got some strategies that I'm putting together, and for your benefit, what I will do actually is I'll put together a video and explain to you how to use one property asset, which is, for most of you, most of my clients have a principal place of residence or some form of property. They might have an investment property that they've got, but they're not living in it. Nevertheless, they have one single property asset that they can use and effectively lever that and invest in things that give you a higher return, effectively making you become the bank. And I'll do a video on that and send that out. If you do own a lot of investment property at the moment, you've probably missed the opportunity to sell it, but you might consider offloading some of or cleaning up your balance sheet and reducing your debt level to weather this storm of a higher cost of capital before it's too late. Okay, finally, earnings per share slowing. Oh, and by the way, I know I shouldn't just flippantly move on. If that is a concern that you have about anything to do with your balance sheet or your current situation, please click on the link. I believe there's going to be a new link in these video messages where you can book yourself directly into my calendar for us to have a discussion about that. Very happy to have a conversation with you about that and to kick around some ideas. Finally, earnings per share. So all of these things, all of these global macro things feed into corporate earnings, and earnings are declining. And I mentioned this last year as well. Corporate earnings are going to be declining, and part 3 or phase 3 of that of this bear market begins this month. In fact, it may begin tomorrow, in the sense that we've got some. I think some of the big financials are reporting earnings tomorrow. We've already begun to have earnings reports coming out, and I just wonder, do I have a quick chart here? No, that's something different. I was going to show you one of the tables that I often show of earnings, but I'll do that maybe in my next update because we'll have more data. But earnings this year are already down about 10% across the board. There's only one sector that's reporting positive earnings, and that's energy, because we had high oil prices and stuff. But that will reverse probably by the end of this year. So corporate earnings are going to be terrible. If you think about it, it's not hard to get there. We have a consumer that's tapped out. Spending is down. We have interest rates rising. Cost of capital to businesses are rising. and just a general economic environment that is bad. So that's going to mean lower earnings, and as such, the stock market is going to have to reprice a lot of these equities for lower earnings. We've been living in a world of bubbles everywhere, and the bubbles are bursting. And we've already seen that in stocks like a great example is Amazon and Tesla. They've had their market caps just pounded and pummeled. Apple as well. I think at one point there was something like $2 trillion of market cap that's been wiped just in a couple of those big names alone. It's pretty amazing actually to have watched all of this. But there was rampant speculation in these stocks. It's just that simple. In any case, earnings are going to continue to slow. That's going to be bad for equities broadly, and so that's why I'm staying clear of the market broadly. There's certain sectors, however, that will be able to weather this storm. And just quickly before I wrap up, I don't want to hit you with too many heavy things to get back into it for this week, but we do want to own precious metals and treasuries and a few other defensive type holdings, which I won't go into great detail. And I've cleared the decks of a couple of things this week in client accounts to prepare to take advantage of what I think will be a great buying opportunity in a few things coming up in the next week to 2 weeks. The main thing that I think is going to happen is the U.S. dollar has been hit a little bit, probably because of this whole pivot story that's out there that the Fed is going to start cutting rates, and that's bad for the dollar. So the dollar's been sold off against other major currencies: the Aussie, the euro, the yen, and pound, to name a couple. But I think that's going to reverse, and we could actually see the dollar strengthen quite heavily in the next couple of quarters. Remember, quad 4 is what we're in for the next at least 2 quarters, and in quad 4 the dollar is an outperformer in terms of currencies. So if the dollar goes up, we'll typically see things like gold and silver and the gold miners, which are equities of course, sell off. But I will be looking to, but at a certain point in that cycle, they are outperformers because we know that the response by central banks eventually when we go into recessions and things like that is to start cutting rates. So gold is kind of indicating that at the moment. And again, I think in the next 2 weeks I'll be repositioning in gold, silver, platinum, and the gold miners. So with that, I think I'll wrap up this weekly update. It's a lot to take on board for the new year. But the last thing I'll say is I'm very excited about this year. I think there's going to be some great opportunities to make money. We're well prepared for that right now. Lots of cash sitting around. I am not going to get overly excited about the markets. I know I've just said I'm really excited, but not overly excited to the point of being impatient. And in my next update, actually, I'll just preface this. I've been reading a set of books from Ryan Holiday, and they are he sort of is he's writing about the Stoic philosophers and applying a lot of that ancient wisdom to modern life. And the books are easy reads. I've really been enjoying them. I'll share with you the titles that I've been reading and what I've read because I think many of you would love reading this stuff and would also get a lot out of it. But with that, I will say happy Friday. Have a fantastic weekend. Welcome back if you've back to work. If you're still on holiday, I'm jealous. And I will talk to you all again next week. Have a great weekend. Bye-bye.